Welcome to StockOdds Odds and Ed podcast. I'm Dave Singh here with Rob Friesen. Good evening, Rob. How's everything?
Not too bad, thank you. Did you have a good Christmas? Busy?
I did.
Busy?
Busy. Lots of families. I'm ready to get back to trading.
Excited to get back to working. Oh yeah, I'm tired. I got to catch up on some sleep, that's for sure. But anyway, let's go through some things for our troops here. See if we can be of assistance to them. So what do you got first on the docket regarding what's coming up this week here?
Yeah, in terms of
actually, hold on a second.
Sure.
Why don't we run a little bit through? We make up this stuff as we go, don't we, Dave?
Yeah.
Let's go through a little bit of review here in terms of where we've ended up, and then we can juxtaposition that against next week. And we're going to leave the thoughts for January until next Monday. Monday's a holiday. We'll be doing the show on Monday at some point. And so that'll give you another long weekend coming up. But we'll leave the thoughts for January until then. See how this year ends completely. But for now, the week between New Year's and Christmas is kind of quiet anyway. So we could just, have more of what we've already had. So let's go through what we've had here. First of all, as of the close on Friday, the Dow Jones was down 8.6%. That's year to date. The mid-cap 400 is down 14.3. The S&P is down 19.3. And remember, we mentioned last week the RSP, that's the equal weighted S&P 500. And so that puts more emphasis on the mid-cap range. So just you can see that there's been a little bit better performance there than some of the mega caps this year so far. The Russell 2000 is down 21.6. And normally the Russell, starts its best 6 months of the year, November 1st on through April 30th. And, it's had some little green shoots along the way, but it's still suffering, but not as bad as the NASDAQ composite at large here is down 32.9%. So if there was ever an opportunity for a comeback tour, it would be, buying the NASDAQ and shorting some of the Dow components that have been most robust. So that would be a mean reversion opportunity, but we'll have to see how that transpires in the new year, and we'll talk more about that next week. So we've ended up, as of Friday, with that kind of landscape. We've had a fair amount of economic news that showed that inflation is still up, and the Fed is not going to be able to be that lenient and have to continue to be on top of things, which is going to still carry over for this week. The tax loss selling should be, I would think it would be mostly done, but you never know. There could be another couple days of it. They do need to clear the stock before the end of the year. So that means the last day is probably Wednesday for any final sales on tax loss selling. And there is great argument for locking in some of those losses and then rebuying those things in the new year if you still want them. But you got to wait 30 days before you buy them back for the wash sale rule. So anyway, the landscape here as far as the groups year to date, bring that up, groups year to date, energy came in so far at 38.91% green, utilities down 1.82, consumer defensive 6.62, basic materials minus 8.2, and healthcare minus 10.02. So, and industrials minus 10.89. So really, like those areas that we talk about all the time about these are the defensive areas, the one to exclude would be the energy, because that that has the sort of that war and you know, all of the sort of implications of refineries offline and lack of spending. So very political. So we'll just not think about energy at the moment. Just so think about utilities, consumer defensive, basic materials, healthcare, and industrials. Those all did better this year than consumer services, down 39.42%. Consumer cyclical, 37.32. That's all your discretionary stuff. Technology, 34.35. And real estate, 28.55. So real estate obviously affected heavily since, interest rates have kind of slowed down that whole area. Now, at first, there was a lot of real estate rallying with the financials when they were starting to raise rates because it was sort of beneficial, but obviously by the end here, it's really taking a toll. So when we talk about risk on, we mean money being willing to flow into these really beat down groups of consumer cyclical, technology, communications, even to some degree, financials. When we talk about risk off, that means money flows out of those and is going to move more so into consumer defensive, healthcare, industrials, and utilities, especially. So this is how we focus ourselves sector-wise. And I sent out a wrap-up for the NASDAQ list that we do, 5 longs and 5 shorts, which are, again, algorithmically chosen. But Friday's was a good example of how important sectors can be. So the sectors that ended up in there were not chosen by a human. They were chosen algorithmically. It's sort of happenstance that it ended up that way. But the outcome was that the shorts were perfect, like bang on, and the longs were bang on. So the way that the money flowed on Friday was, perfect according to our sectors that we had in there. So healthcare was weak, and some chip makers and stuff were strong. So that mix gave us, really great performance in a basket, a hedged basket, to make like 1.58% is very robust. So if you, in your, activity of preparing lists, preparing a risk on list, a risk off list, and a neutral sort of quantitative list, and then looking at the landscape and deploying the right list, you're going to get that extra bang for your buck. We want the quant baseline to be performing, on average all the time, like a metronome, but you're not going to get the enhanced returns if you don't line yourself up with sort of the market's appetite. And if you can do that extra step as you grow and get more experience, more insight, more education, more samples under your belt, right? You're going to be able to then skew your exposure in the most beneficial manner. So don't think it happens overnight. It will happen over time as you mature in doing this every day. But that's the key. You got to do something every day. And if you have no idea what to do, stay with the complete quantitative basket. That's fairly diversified, exposures across different sectors. So there's nothing really concentrated. And it's just going with your odds and average performance and expectation and stuff that we've talked about. So that will help you get the most consistent, stable results. To then take it to the next level means you have to apply capital to, the best opportunities. Okay. So hope that helps. Now, Dave, since we've ended Friday year to date that way, What is the outlook for this next week? It is a shortened week. We've only got 4 trading days, and it's also going into a long weekend and the last trading day of the month, the last day of the year. So there's a kind of a lot packed into these 4 days. What insights can you give us?
Yeah, in terms of the seasonality almanac, the last 5 days are a little bullish, but the last 3 days are kind of bearish, a little bit of sell-off. And of the last 5 days, the first 2 or 3 have the most robust return, where the final ones don't. And I looked at some of the sectors within that. So for the final 3 days of the month, pretty much everything is down. With it's safer to be longer gold and real estate. So GDXJ 2.06% performance, GDX 1.25, IYR, the real estate ETF 0.4, and then shorter things like ARK funds, ARKG down 1.86%, ARKK minus 1.83%, biotech, IBB, XBI, XLK, QQQ. So all the risk on stuff seems to be weaker for those final 3 days, and gold as a long. And you look at the final day of the month. There we see it's expected to be a down day, and sectors within, let's see, oil and financials would fare a little bit better typically, and shorter things like the risk on stuff, ARK funds, SMH, biotech, XLK. So there is a case to be made for which sectors to be involved with these final days, but that's what we're seeing in terms of the almanac. And then in terms of tomorrow, I did a little screen to see of the 4 ETFs, QQQ, Diamond, Spider, and IWM. Does StockOdds say anything about what's a little bit better for tomorrow's trading? And QQQ is showing up to be quite bullish in terms of RSI, screen, BB, and momentum. And IWM is the weakest of the 4. So given that could also give you some outlook as to where you want to deploy your money. It's not where you just put 1/3 your capital in each different index symbols, Spider, QQQ, and NASDAQ. Maybe you lean a little heavier on your NASDAQ capital allocation and less on your small caps, right, that kind of thing.
Well, we call that deriving a bias for the day. So it's important to first prepare your lists so that risk on, risk off, and neutral. It's also important to run the scenarios of what might happen. How might the day play out? You might get a better picture of that when you see how the futures are trading, how the market is, pre-market, what's been the low and high, which way are we drifting, whereabouts are we going to open in relationship to the previous day's close, and so on. But then you're taking and forming a bit of a bias, and there's nothing wrong with forming a bias, but it has to come from somewhere. It doesn't come from just thin air or goosebumps or whatever. You have to form it from something. So what Dave's saying is take that extra step, and I think he's found it to be valuable in his own trading already, is take the extra step to identify the 4 ETFs in terms of what their odds and average performance output for the next time frame that you're trading, whether that's open to close or it's swing trading 3 days or whatever. We're very granular, so we're doing open to close, and you get that sort of bias behind you so that you're already prepared, and then perhaps even position sizing and choosing the allocation of capital in the various groups. And again, his reference was, if you have 3 main areas that you're drawing from, say the Russell 2000, the NASDAQ 100, and the S&P 500, and there are some overlapping symbols between the NASDAQ and the S&P 500, but you're taking and applying your capital, in a way that's relative to those volatilities and those risks. So everything is risk adjusted, right? Everything is risk considered. And don't do this. Like if you have the same symbols coming up in NASDAQ as coming up in S&P, don't double your capital. just because a symbol's come up twice. Just use that capital only once. I don't agree with the doubling thing, just because, you know, if you get it wrong, you're really going to get it wrong. You know, just focus on risk reduction all the time, and it will play out better for you. Okay. Anything more, Dave, on that?
No, or you can also swap out an ETF for that duplicate symbol.
Sure.
Yeah, that's another way to reduce it. So, economic calendar. I mean, we have a couple reports coming out this week, mostly around housing and jobless claims. So Tuesday, there's the Case-Shiller U.S. Home Price Index report, and then Wednesday we have pending home sales, and Thursday initial jobless claims. So there's still a couple economic reports that the market's going to be looking at, but mostly around housing and then jobless claims later in the week, and then Friday the Chicago PMI. So it's not too much in terms of reports and earnings. There's not a lot of earnings this final week. There are some smaller cap ones that do have some earnings, but nothing major.
Okay. You know, there's a lot of banter on you know, what's going to happen here with the war. I know that Zelensky has you know, made another appeal to Congress and everything. So there's a lot of support going over there. And anyway, he's on the cover of the Time magazine for Person of the Year. So who have been some of the other persons of the year? Just out of curiosity, looks like, just going back to 2019, was Greta Thunberg. And then 2020 was Joe Biden and Kamala Harris. 2021, Elon Musk, when he was the richest person in the world, and no longer such. And then this year is Volodymyr Zelensky and the Spirit of Ukraine. So the question is, what has happened to all the people that have been on the cover? It's like, do you really want to be on the cover? Is that the, you know, is that the kiss of, you know, sort of you're at the top of your game and that's downhill from there, or what?
So it seems like
that's what happened to Elon anyway. I mean, also with Greta, like, great message in 2019, and then 2020 COVID hits and disrupts the whole world, supply chains, this and that, and now we have you know, many places going back to coal. I mean, right now in Ukraine, they're actually running coal-fired trains for transportation because the other systems have failed. So, you know, at the end of the day, we need energy, and no matter where it comes from, it kind of takes place of this noble desire for, you know, green energy. It's we're still worldwide, we're still a long way from that. But anyways, it's just interesting that what happens to people on the cover of the Time magazine as Person of the Year. I find it fascinating. Anyway, what else we got?
China relaxing.
Oh, yeah. Well, relaxing, but also tons of cases, like 37 million in a day or something, and things are going kind of crazy over there. So who knows how that's going to play out? And this whole China thing really impacts our markets because of the global growth implications, right? And weather, you know, like you were mentioning to me earlier, like the weather situation also impacts consumption in terms of energy. And so we had a very bullish Friday end to oil, but, you know, who knows with all the storm stuff, whether that will pull back again, right?
Mm-hmm.
Yeah.
If no one can get around and consume oil, so let me.
Well, I mean, how many people do you think still rely on oil for heating versus natural gas? I mean, is there still a lot of oil heating in the East Coast?
I don't know the numbers. I'm wearing t-shirts, shorts and t-shirts out here.
So what do you know? You're in California. Well, you did have some. We tried to push some cold weather to you. Hopefully, it hit you, and I don't know. It'd be kind of funny if you got snow in your area. Eh?
Yeah, we'll see. It's like 80 degrees right now.
One time when I was heading down to California for Christmas break, or was it closer to spring break? I can't remember. We were taking the kids to Disneyland, but anyway, we came across some serious snow. The grapevine, that was all we couldn't even go up the grapevine. We had to go over to the coast and go down the coast highway.
Yeah.
So it was a terrible year for snow kind of encroaching on your area. And I think it was like almost freezing temperatures at Disneyland. Not a great year. Anyway. All right. Well, we'll let you go. Have yourself a good day, and get ready for trading this week. And just remember, volumes can be a little bit lighter, and the market still has potential to continue a little bit of a Santa Claus rally. We saw kind of a desire for that on Wednesday, and then we pulled back Thursday, and then Friday was the first official start to Santa Claus rally, and it was up a little bit. We didn't mount too much, but there was hardly anybody out there trading. A lot of people were traveling and stuck traveling, and a lot of people made a really long weekend of it. So volumes were light, and that is expected to continue this week. But we have this pressure cooker of 4 days for a lot of stuff to get resolved before the end of the year. So who knows? Let's leave it on the table that the Santa Claus rally is still possible. If I look at the US dollar versus euro dollar right now, the euro dollar is up slightly to the US dollar, indicating maybe a bit more of a risk-on environment. Commodity currencies are up a little bit as well, so might be a bit of a support to commodities. So I'm going to allow for a little bit of a Santa Claus rally, but this isn't the type of year where I expect a massive rally, like everybody has to be in. I think they would probably defer that if they've done tax loss selling into January and buy it back then. So we're going to have a look forward at 2023 on our next wrap up next Monday. So we'll catch you then.
All right. Good luck. Thanks.